What if the one asset you neglected could drain your savings long after the divorce papers are signed? You've argued over the house, the bank account balances, even who keeps the family car. Yet most women breeze past that single, powerful claim that holds the key to their future security. It lives hidden in your spouse's employment benefits, waiting in the fine print, ready to slip off your radar when you need it most. Imagine thinking you've split everything, only to discover years later that a crucial clause was missing, leaving you locked out of income you deserved. That small oversight can cost you tens of thousands in retirement income, survivor payouts, or government benefits. And once the decree is final, there's almost no coming back. Stay with me. She thought 50-50 meant half her pension. Until she found out she never had the paperwork to claim a single penny. Most divorcing women glance at that retirement line and assume splitting it is as simple as dividing the number on paper. But without a properly drafted qualified domestic relations order, those funds remain locked in your spouse's account, untouchable and growing while you watch from the sidelines. Imagine negotiating for months, finally settling on a neat split of his company pension, only to log in one day and see the balance unchanged, because the court never issued the QDRO that legally transfers your share. Worse, any attempt to roll those funds into your own IRA without that order triggers hefty taxes and early withdrawal penalties. Suddenly, what looked like a solid nest egg evaporates into fees and fines. Securing that order isn't optional. It's the very document that transforms a promise into reality. Insist your attorney files it before you sign the final decree, confirm it's been accepted by the plan administrator, and keep proof in your records. Because if you skip this step, you don't just lose money today. You lose the retirement you spent years building. And as you'll see next, winning your share of the pension is only half the battle once you start thinking about survivor benefits. You may walk away with half the pension balance. But what happens if he passes first? Claiming 50% of the monthly payout is only half the battle. Without negotiating survivor benefit provisions, your income stream can vanish the moment he's gone. Defined benefit plans often default to paying surviving spouses, but only if they're named beneficiaries. If you skip that clause, the plan may pass your share to his next of kin or even revert to the employer's estate policy, leaving you with nothing when you thought you were protected. Life insurance policies carry the same trap. Group term life through his work might pay out a death benefit. But if you're not explicitly named as the beneficiary, the proceeds could end up in probate or swallowed by taxes. Insist on joint and survivor language for any pension or group life plan, and confirm that your name appears on every relevant form. This extra paperwork costs almost nothing in lawyers' fees, yet it can secure years, maybe decades, of income you'll rely on after divorce. But locking down those survivor benefits isn't the end. Next we'll uncover the government-backed entitlement most women never claim. She watched her ex collect every penny of his full Social Security retirement, and she never even filed her claim. Most divorced women assume their FICA benefits evaporate with the marriage, but under U.S. law, if you were married at least 10 years and remain unmarried, you can claim up to 50% of your ex's retirement benefit, even if he's already drawing it. Think about Jenna, who dutifully applied for her own reduced benefit at 62, never realizing she could have doubled her monthly check simply by filing as a spouse. By the time she learned the rule, she'd already locked in a lower rate, leaving thousands on the table for the rest of her life. And that's before we talk survivor benefits. When her ex passed away, she found out too late that she could have stepped into his full rate, nearly twice what she was getting. Filing for spousal or survivor benefits requires no extra negotiation at divorce, but it does demand awareness and timing. You must wait until your full retirement age for the maximum spousal amount, and you need to coordinate your application to avoid penalties. Survivor claims kick in quickly, but only if you meet the eligibility criteria and submit before any divorce decree deadlines. A quick call to the SSA, armed with your ex's Social Security number and divorce paperwork, can unlock this hidden income stream. And while tapping into government benefits might feel less glamorous than dividing a home or a 401k, it's free money you've already earned through years of marriage. Miss this step, and you'll be left wondering why your peers seem to live comfortably on their checks while you scramble to make ends meet. Next, we'll uncover the asset hiding in her career, worth far more than the condo. That little side gig you built on evenings and weekends can dwarf the equity in your family home, but only if you know to value it. Your professional goodwill, client lists, referral networks, branded expertise, qualifies as marital property, yet it's often written off as just business. Imagine running a boutique consultancy or healthcare practice for years, then watching your ex negotiate a buyout based on an accountant's rough estimate rather than a full appraisal. Without expert analysis, you end up with pennies on the pound while the true value of your hard work slips through the cracks. Insisting on a forensic valuation of any business interest isn't optional. It's essential. That means hiring a specialist to examine revenue trends, profit margins, brand strength, and future earning potential. Not just eyeballing a tax return. Whether you're a solo practitioner, a freelance designer, or a partner in a family venture, every intangible asset, from your reputation to your book of business, must be translated into a number on the settlement sheet. Leave it out, and you effectively gift your ex a thriving enterprise at a fraction of its worth. And if you think that's a stretch, wait until you hear how your online presence, social channels, domains, subscription lists, can be the next goldmine most women forget to protect. Your Instagram feed isn't just a scrapbook of vacations. It can be a six-figure revenue machine if you know where to look. From affiliate links on TikTok to subscriber lists on newsletters, any monetized digital foothold counts as marital property. Imagine pouring months into building a lucrative YouTube channel or an email list that generates ad revenue, then watching your ex walk away with half the condo while your entire online business never even makes it onto the settlement sheet. To protect this hidden goldmine, you must inventory every digital asset. Domains, social accounts, subscription platforms, ad revenues, even cryptocurrencies, and insist on an expert valuation that translates likes and clicks into hard numbers. That means analyzing traffic metrics, revenue streams, sponsorship deals, and growth forecasts, then spelling out exactly how each asset will be divided. Leave your online empire out of the paperwork, and you effectively gift your ex a turnkey business at your expense. Now that you've secured your digital domain, it's time to lock down something even more vital. Your health coverage, before that final signature seals your fate. You wake up one morning, log into your insurer's portal, and your coverage has vanished. In the whirlwind of negotiations, health insurance often feels secondary to houses and bank accounts, but losing your plan can cost more than you ever saved in that divorce settlement. Without an explicit clause binding your ex to maintain your group coverage or to subsidize COBRA premiums, you'll scramble for a new policy at steep rates, higher deductibles, and a limited provider network, right when you need care most. Think about Maria, who never asked her lawyer to lock in those benefits. 3 weeks after signing, she got a call from her doctor's office demanding payment for a routine scan. The divorce decree said nothing about insurance, so her ex's HR department dropped her immediately. Facing a gap in coverage for her chronic condition, she ended up with thousands in out-of-pocket bills and a plan that wouldn't cover her preferred specialists. Replacing employer-sponsored insurance mid-year was nearly impossible outside open enrollment, leaving her stuck in limbo. Protecting yourself means spelling out every detail in black and white. Name yourself as beneficiary on group life policies, require a specific COBRA subsidy for a set period, or mandate private coverage payment until you secure your own plan. Confirm with the insurer that your ex's obligation is enforceable. Then keep documentation in your divorce file. A few extra lines of legalese can save you from medical debt and endless phone calls to billing departments. And don't assume insurance is the only hidden expense. Next up, we'll uncover tax liabilities and debt traps that can blow your settlement wide open if you're not prepared. That equal debt split you agreed to in the heat of negotiations can sneak up on you when you least expect it. You might think trading off a few credit card balances for a cleaner property division is a fair swap, until you find your credit score cratered by missed payments you didn't even know were your responsibility. Joint loans, tax liens, utility arrears, even that medical bill your ex thought was paid off, can all be lumped into your column without a buy your leave clause, leaving you on the hook for penalties, collection calls, and skyrocketing interest rates. Protecting yourself means forcing a full accounting of every liability before you sign. Insist the decree names who's legally on the hook for each account, and build in enforcement measures. Property liens, wage garnishment rights, or built-in offsets that reward you if you end up carrying more than your share. Better yet, negotiate debt gross-up language. If your ex skips a payment, they make it right by sending you extra cash, rather than letting your credit take the hit. This way, you're not left scrambling to refinance a ruined score or raiding your savings to cover surprise expenses. And don't forget the taxman. Every asset transfer and retirement rollover can carry hidden levies. Modeling each scenario with a trusted tax advisor and tacking on a gross-up clause to cover future bills turns nasty surprises into manageable line items. Miss this step, and that tidy portfolio swap can shrink to a fraction of its worth once capital gains rates and early withdrawal penalties do their work. All these oversights can be fixed if you act before that final signature. Now that you've walked through the 8 hidden traps, from locking down your QDRO to valuing every digital and professional asset, securing survivor benefits, health coverage, and debt protections, take a moment to imagine your life if just one of these had slipped through the cracks. Each clause isn't just legal jargon. It's a safeguard for your independence, your peace of mind, and the future you deserve. If your decree isn't final, bring these points back to the table now. Ask your attorney to draft or amend the necessary language before you sign anything. And if you're already past that stage, don't lose hope. Post-divorce modifications, side agreements, or even targeted litigation can sometimes reclaim what you missed. The key is awareness. Knowing exactly what to fight for and when. Which one of these 8 would have made the biggest difference in your own divorce? Drop the number below and share your story. Your insight could be the wake-up call another woman needs. If this guide opened your eyes, please give it a thumbs up, subscribe, and hit the bell so you never miss another critical tip for protecting your financial future. Thank you for watching, and here's to negotiating the settlement you truly deserve.